What if your retirement account could suddenly pour money into crypto? An executive order just made that possible for 90 million Americans, potentially unlocking a piece of $9 trillion. This isn't just a rumor, it's happening now. At the same time, one firm is making a massive $5 billion bet on Ethereum, not just to hold it, but to use it as a cash-generating machine. While this institutional money flows in, experts like Elio Trades say the market will move slower but higher. But there's a catch. A surprisingly strong US dollar is putting the brakes on everything for now. The entire market is holding its breath for one thing that could change it all. Are you ready for what comes next? In the latest video from Altcoin Daily, crypto veteran Elio Trades lays out his forecast for Ethereum and the wider market, arguing that we're in a completely new phase driven by institutional money. He says that while regular investors are still ice cold on crypto, big players are just getting started. Elio believes the next major move for these institutions after Bitcoin will be into Ethereum and DeFi. He sees a future where traditional finance moves on-chain, a sentiment he says is echoed by figures like former SEC Commissioner Paul Atkins. Elio's take feels very grounded in what's happening right now. The idea that institutions are the main drivers isn't just a theory. We're seeing it happen. The approval of Bitcoin and Ethereum ETFs was the first big step, creating a regulated bridge for Wall Street money. His focus on DeFi as the next thing also seems right on the money. Big firms like BlackRock and Franklin Templeton are already tokenizing real-world assets, RWAs, on blockchains like Ethereum. This is exactly the kind of on-chain financial activity Elio is talking about. It's no longer a fantasy that markets will move on-chain. It's actively being built by the largest financial players. This supports his slower but higher thesis, as institutional flows are more like a steady river than a retail-driven flash flood. In the latest video from the Crypto Tips channel, the host connects the dots between rising inflation and why younger generations are being forced to make riskier investments. He argues that the government's official inflation numbers are misleading because they don't properly account for food and fuel costs. This desperation is pushing people into the market, as shown by a Harris poll indicating 60% of Gen Z invest outside their 401k. The video features a clip from a tweet by Heidi at Blockchain Chick that explains the creation of the Federal Reserve as a private entity designed to profit from creating money and inflation. The video's focus on Fundamental Global's $5 billion plan to acquire Ethereum is spot on. This isn't just another company adding some crypto to its treasury, it's a publicly traded firm building a core business strategy around accumulating and utilizing ETH. It signals a shift in how institutions view Ethereum, not just as a speculative asset, but as a productive, yield-generating platform through staking and DeFi. While the host correctly questions the conviction of short-term corporate buyers, Fundamental Global's move seems to represent a much deeper commitment. This type of strategic adoption is a powerful narrative that separates Ethereum from the digital gold case for Bitcoin and could attract a completely different class of institutional investors who are looking for cash flow from their assets. In the latest video from Lark Davis, he talks about the US dollar's recent pump and what it means for crypto. Right now, the American economy looks surprisingly strong with 3% GDP growth and a low unemployment rate of 4.2%. Because of this, the Fed is keeping interest rates high at 4.25 to 4.5%, which makes US Treasury bonds a sweet deal for global investors. When they buy bonds, they need dollars, and that demand makes the dollar stronger. The inverse relationship between the dollar, DXY, and Bitcoin is a well-known theme in the crypto space, and this video breaks it down well. My take is that while the economic data points presented are solid, the situation is a bit more tangled these days. Geopolitical tensions often cause a flight to safety, pushing investors into the dollar temporarily, which can muddy the waters and disrupt that clean inverse correlation. The real elephant in the room is the Federal Reserve's next move. The market is heavily anticipating an interest rate cut in September, which would almost certainly weaken the dollar and act as a tailwind for assets like Bitcoin. If that cut gets delayed due to stubborn inflation data, we could see the dollar's strength stick around longer than expected, keeping a lid on crypto's momentum. It adds another layer of uncertainty to an already tense market. In the latest video from Ben Cowan, he takes on the common belief that the Fed cutting interest rates will make homes more affordable. He argues that the exact opposite can happen, and he explains why. The main issue is that many people confuse the Fed's short-term rate with long-term mortgage rates. Mortgages, like the 30-year fixed, are actually tied to the long end of the yield curve, such as the 10-year Treasury yield, usually trading about 1.5% to 2% higher. It's interesting to hear this perspective because it cuts against the grain of what you typically hear in mainstream news. Cowen's logic is sound. The bond market's reaction to Fed policy is driven by a constant tug-of-war between fears of inflation and fears of a recession. Right now, with inflation still being stubborn, it's completely plausible that a premature rate cut would be seen by bond traders as an inflationary signal, causing them to demand higher yields. His point that what's needed is lower asset prices is the part that many people don't want to hear, but it reflects the difficult economic trade-offs at play. It really forces you to look beyond the headlines and consider the second-order effects of monetary policy, which are often not as straightforward as they seem. In the latest video from Crypto Wendy, she announces that the Ripple versus SEC case has concluded, but quickly shifts focus to something she believes is even bigger for the average person, a new executive order. This order now permits 401k investors to allocate funds to alternative assets, including cryptocurrency. This move could potentially direct a portion of $9 trillion in retirement money into the crypto market. According to David Sachs, this gives 90 million Americans a new way to invest their retirement savings. It's interesting to see the excitement around integrating crypto into traditional retirement plans. The video frames this as a massive, immediate opportunity for everyone. While the enthusiasm is understandable, the situation on the ground is still developing. Big players like Fidelity have made moves to offer Bitcoin in their 401k plans, which is a huge step in making crypto a more mainstream investment. However, regulatory bodies, especially the Department of Labor, have consistently issued warnings about the volatility and risks involved. It feels like we're watching a tug-of-war between financial innovation and regulatory caution. The potential is there, but the path to widespread, easy access to crypto in every 401k plan still seems to have a few hurdles. In the latest video from the Crypto Jeb channel, the host lays out a strong case for why Bitcoin could rally to $140,000 in the next 60 days. He explains that technically, Bitcoin is in a very tight spot. It's currently finding support on a massive 7-year-long trend line around $116,250. But it's bumping its head against resistance near $118,000. A break above $118,000 could send the price flying, while a drop below $116,000 could mean a trip back down to $112,000. Indicators like the MACD are getting ready for a bullish cross, adding to the tension. It's interesting to see how much the narrative around Bitcoin's price has shifted to include mainstream politics and macroeconomic policy. The points about the 401k rule change and gold tariffs aren't just minor news items. They represent a real change in how major world governments are interacting with assets. The 401k development seems particularly significant. Previous bull runs were driven by retail hype or the launch of a single ETF. This introduces a mechanism for slow, steady, and automated buying from trillions of dollars in retirement funds. Even a tiny 0.5% or 1% allocation spread across millions of accounts creates a constant source of demand that the market has never seen before. It could change the entire structure of the market cycle, making dips shallower and providing a much stronger floor for the price. The perfect storm analogy feels pretty accurate when you stack these powerful fundamental shifts on top of a tense technical setup.